Good afternoon, everybody. Joe Stevens here, certified financial planner. Thank you so much for joining me this afternoon. Still a few people popping in, so I'll just give this a little bit more time and we'll get started probably within about 30 seconds or so. All right. Hope you're enjoying the lovely New Jersey weather today. I think it's raining and then it's going to snow, only in New Jersey. All right. Let me get this ready here. All right. Well, in the interest of everyone's time, we are going to get started. So, good afternoon. Again, my name is Joe Stevens. I'm a certified financial planner at Associated Financial Planners in Spring Lake, New Jersey. Today, we're going to talk about some retirement strategies for wine and spirits professionals. And as a certified financial planner and a certified sommelier, I think I bring a unique perspective to this community. I actually spent the early part of my life working in retail at wine shops with my family. And then I went on to work for Gallo in a supplier distributor role as the luxury manager for New Jersey. So I think that perspective, along with my experience as a certified financial planner, can bring a pretty unique perspective to this exact topic that we're going to talk about today. So appreciate you taking some time on a Thursday to listen in, and let's get started. So who is this webinar for today? This webinar is for wine and spirits professionals, ages 45 to 65 that are ready to get a real picture and not just a sales pitch. Folks that want to, work to become a choice, not an obligation. And ultimately, they leave today with some clarity and not just information. That's why we're doing this. So I'm going to talk a little bit about a story and a reality that I see all the time when I work with clients. A lot of the sales professionals that I work with, they make great income. They've built an incredible career. They've actually saved very well throughout their career, but they're still unsure of that next chapter and how to actually make that transition to work optional or retirement. And ultimately, the wine and spirits industry is really unique. Incomes are really strong, but they're unpredictable. And, as we know, companies change, territories shift, bonuses fluctuate year to year. And most of these companies nowadays, there's no pension. So what I've learned from all these meetings is that making good money is not the same as building financial independence. Okay. So my goal today is not to overwhelm you. It's to show you how to turn a career of variable income into something predictable so work can become a choice, not an obligation. So let's get into it. So let's start out with a familiar kind of story. Okay. A lot of the folks I work with have a base salary, they get a bonus, and they also receive some supplier incentives. Okay. This equates to an income that swings wildly from year to year. Those supplier bonuses that you get, or distributor bonuses, or however that's worked out, it feels great, but you're unsure of the tax consequence that comes along with it. And without proper planning, that's exactly what can happen. You have 401ks from 3 different distributors. They've never been consolidated. Okay. There's no pension. Like I said earlier, just what you've saved, and that clock is running. You're still hitting your quotas, but you're wondering, when do you get to choose to stop working and make work optional? Okay. So here's the unique challenge in the wine and spirits profession. Earning well does not automatically mean retiring well. This is why it's so important to have a plan. That W-2 salary plus the bonus plus those incentives equate to a very complex tax picture. We have to deal with portfolio changes. And I'm not talking about stocks and bonds here. I'm talking about the portfolio that you sell. We have to deal with acquisitions and territory shifts. They all reset the clock, right? The lifestyle that comes with this role is hard to scale back. Okay. The quote I hear all the time is, I'll figure it out next year, until suddenly there is no next year. So, why does this matter now? You're likely in your highest earning years right now. The decade before retirement is when strategy and planning matter most. A bad sequence of decisions now can take years to recover from with your plan. So, here's what we're going to cover today. Okay. We're going to start with how to maximize your 401k during those high income years. We're going to talk about how to build a reliable monthly paycheck in retirement. We're also going to go through the tax time bomb that's hiding right now inside of your pre-tax traditional 401k accounts. Okay. We're going to talk about protecting what you've built if income suddenly does stop, and what a coordinated retirement roadmap actually can look like. So this is a fictional couple, but this is a real example. And this is a good case study for us to discuss today. So we're going to talk about Mike and Lisa. Mike's a VP of sales at a distributor or a supplier. He's in his 50s. He has high income, over $200,000. His spouse works in education. They've got 401k assets over $1 million. They have an IRA of $250,000. Eventually, they'll have Lisa's pension, which is $1,200 a month. And their target need in retirement to run the household is about $9,000 a month. Okay. So let's break that down a little bit. Here's the question that they asked me. Can we step back confidently, or do we need to keep pushing? I get this question all the time, and this is exactly why having a plan and having that confidence and clarity is so important. Your 401k is more powerful than you think. In fact, it's probably your most powerful savings vehicle, and it's often underused. It lets you control when you pay taxes, either pay them now or you're going to pay them later. Okay. And we're going to get a little more into that in a couple slides. But the base, your 401k is the base of your retirement paycheck if it's invested properly. Okay. So here's a couple common mistakes that I see. I see a lot of folks that only save to the company match. They know it's, 4% or whatever that specific company is, and they leave big money on the table every year. They skip the Roth options in their plan because they think, I'll be in a lower tax bracket later, so it doesn't matter. They're in the same default investment allocation from 20 years ago when they first started with the company. So that could mean they're using that same target date fund that they enrolled in, back in their 30s. Okay. That needs to be looked at and needs to be adjusted as time goes on. They have old 401ks from other companies that are sitting idle and haven't been looked at in 15 years. So let's get into the pre-tax versus Roth strategy. Okay. And thank you for all those that continue to join. I really appreciate it. We are recording this, so you will be able to rewatch it. So pre-tax versus Roth. Pre-tax reduces your tax bill today. So you get a deduction on your income taxes, but what that does mean is every dollar will be taxed as it comes out in retirement. Okay. Roth means you pay the tax now, but it's tax-free income and growth forever. Okay. Which means a lot more flexibility in retirement. What we really want to consider is this split strategy where we can use those variable income years to shift between both pre-tax and Roth. Okay. So we'll get into more of that as we continue on. How do we plan for those years when we receive that bonus? So a big bonus year is a really, really rare chance to accelerate your savings, especially early on, in that timeline that I spoke about at the beginning. Okay. If you can max out your 401k before the end of the year, before December 31st, especially in those high income years, it's going to make a drastic difference in the outcome of your plan. Those supplier bonuses and the income that's comes along with that, it's often under withheld. And there's a strategy there to plan for that April tax bill. And there's ways to strategize for that so you're ready and it's not a surprise. Okay. In those years where you don't have the big bonus, this is when we can consider Roth conversions in those lower bonus years to smooth out the tax exposure over your lifetime. Okay. Roth conversions is a topic for a future webinar, too much to get into today in detail, but a great topic to discuss in the future. Retirement is not about a number. It's about replacing your paycheck. So retirement is a cash flow conundrum, and it's all about figuring out how all these pieces come together to create this plan. Okay. So what does $9,000 a month actually require? Well, $9,000 a month equates to $108,000 a year in after-tax income that potentially Mike and Lisa, this fictionary household, would need from day one. Okay. No single source will cover that, but it does require a coordinated income stack. And we're going to talk about what that looks like. Okay. So let's build the retirement paycheck. This is exactly the type of work that we do day in and day out. We need to coordinate all these different income sources like Social Security. Okay. So again, to put some real numbers to this, Social Security for Mike, about $3,200. His spouse's Social Security check, about $1,800. His spouse's pension, when she turns that on, about $1,200. So what do we need to get? That's about $6,000 if we add all those sources up. So we have a shortfall of about $3,000 to get to their goal of $9,000 a month, right? So we need to generate about $3,000 from their investment portfolio. The moral of this story is that this is much more achievable than most people think. You're much closer to this than you feel. $900,000, that bucket at a 4% withdrawal rate equates to about $36,000 a year. Meanwhile, the portfolio is doing the rest of the work. And realistically, we're not putting too much stress on the portfolio. Okay. Now, some years that changes. That's why it's important to have a plan and have those guardrails in place. But ultimately, this goal is very achievable when you start looking at all these different income sources. Okay. My point here is clarity changes everything. You don't want to wonder, am I behind? You need to know exactly where you stand. Every career decision gets easier when you know your numbers. It allows you to choose when to step back on your terms, not your company's. And that's what this is all about, having clarity and confidence. So let's talk a little bit about some of the risks that most people underestimate. Number one, a 30% drop in the market in year one of your retirement can permanently wreck your plan. Okay. Think about the last few weeks, right? There's always some type of event going on in the world. This is why planning is so important, because we need to know, what happens if the market does drop? What's our plan for that? How can we preemptively prevent being in a situation where a 30% drop could affect our portfolio and our plan? You can live 30 plus years in retirement. Your money has to outlast you. What's the plan around longevity? Okay. Healthcare, right? If you're going to retire before age 65, what's your plan for healthcare? You're not eligible for Medicare until age 65. If you need to go out on the exchange and buy insurance, we're looking at a cost of about $1,500 to $25 a month to get healthcare before age 65. Okay. And then lastly, all those pre-tax accounts and all that pre-tax money, it creates a hidden tax bill that's going to grow every year that you wait to start dealing with it. Okay. And we're going to talk a little bit more about that in a second. So let's talk about the tax time bomb. This is that pre-tax money that I just referenced. Okay. A $1.5 million pre-tax account, meaning your traditional 401k, means that $1.5 million is all future taxable as income to you at your ordinary income rate. Okay. Required minimum distributions currently start at age 73. This means the Internal Revenue Service is going to force you to withdraw that money out of those accounts, whether you need it or not. Okay. And then there's IRMA. IRMA is a surcharge that's added on to your Part B and D costs. And it could be an additional $4,000 a year triggered by income if it's not planned for properly. Okay. So let's talk a little bit about how planning creates optionality and levers that you'll be able to pull when you need them. Okay. If you hold pre-tax Roth and taxable brokerage accounts, that gives you the flexibility to control the tax bracket that you're in. Okay. Which account you pull from first determines how much you keep after tax. Lastly, when you claim Social Security will change your lifetime income by $100,000 plus. Okay. What do I mean by that? Well, that's a whole different webinar again, but there's a lot of rules to Social Security, but just know that you can take it as early as age 62, but it'll be discounted from your full retirement age and your primary insurance amount. The max you can get is at age 70. It's not going to get any bigger than that amount. And that's what I'm talking about, how it can change that income by such a large number. Okay. There's a lot of planning to do for Social Security. Protecting what you've built. If you became disabled today, do you have a plan for that? Could your household sustain your lifestyle? Do you have an emergency fund in place? Could you cover 6 months of bills out of that emergency fund if you weren't able to go to work tomorrow? What's the plan centered around that topic? What happens if your territory changes or your portfolio gets restructured or the company's acquired and benefits change and income could end overnight? What's the plan for that? Basic estate documents are crucial to the plan. You need to have a will. You need to have powers of attorney. You need to have healthcare directives. Those are the basic documents that we encourage everyone to spend a little bit of time creating. We also want to look at beneficiary designations every couple of years. Family dynamics change, things change. Even look, at your 401k. A lot of folks don't even realize that your 401k plan provider you could change your beneficiary online. You should always take a good look at who that is and if it's still accurate. Okay. Protect your family. If your bonus stopped tomorrow, would your household still be okay? Or would the clock immediately start running? This is why planning is so important. What's the plan for that? So, what does a real plan include? A real plan includes a clear paycheck strategy. What comes from where and in what order to be as efficient with taxes as we possibly can be. It also includes a multi-year tax planning strategy to minimize what's going to the IRS. Okay. We never want to tip the IRS. It includes portfolio allocations that are matched to your specific timelines and your risk tolerances. Some folks want to be on the roller coaster and some don't, and that's okay. That's why finance is so personal. It includes a plan for disability, healthcare, and income gap protections that are all built in. Lastly, it includes a target date so you have confidence that you know when work becomes optional. Okay. So where I see most sales leaders today, I see them with really strong incomes. They're really good savers. They built a really solid career, but they don't have a written plan. They put money away, but they're not sure if it's enough or if it's in the right places or right accounts. They have accounts in multiple places. They're reactive to tax planning, meaning they go see their accountant in April. Their accountant gives them a couple ideas and it's already too late. They do not have a cohesive strategy and a team that's working together to continue that plan for the foreseeable future. They think to themselves that they'd love to step back in 5 to 7 years, but they don't know if they actually can. And that's why clarity and planning is so important to all this. So, what is a retirement readiness consultation? Retirement readiness consultation is a 30-minute meeting where we actually see if you're actually on track or if you're just hoping that the math works out. What does your monthly income look like? How much tax risk do you have hiding in those pre-tax traditional 401k accounts? What happens if income stops tomorrow from a disability or the company gets restructured? Um, you're going to leave with clear, prioritized, actionable steps without any jargon and without an overwhelming conversation. It's all about clarity. So, who is this for? Just like I said at the beginning, wine and spirits professionals in that age range that are ready to get a real picture and not just a sales pitch. They want work to become a choice, not an obligation. And that's why the planning matters. Here's how you can book. Please scan the QR code if you'd like to book some time with me. Um, I also have a link on my LinkedIn page, and I'd like to continue doing these webinars on topics that matter to you. So I'm going to share my email address in the next slide. Please email me feedback, email me comments, email me future topic discussions. I'd like to run through some of those more complex topics. Anything that piques your interest that can help you. One closing thought that I'd like to leave everyone with today. You have spent decades building your career. Let's make sure that it translates into flexibility. Questions, comments, please direct them to my email right there or book time with me through my LinkedIn page. And I look forward to seeing everyone again soon. Thank you so much for your time today, and I hope you enjoyed this. Take care.